Hello, and welcome to our first quarter strategy review for 2023. We met on December the 28th, and with me were Len Skena, CEO of the firm, Bob Toomey, Vice President and Director of Research, and our special guest was Carling Patel, who is a strategist with State Street Global Advisors. We covered a lot of territory. We certainly looked a lot at the recession situation, and we also looked at how you balance during this period of time to get the best returns with the least amount of volatility. So with that, I'd like to start by switching it over to Bob to talk about U.S. equities.
Thanks, Stan. And I would just echo and concur with Stan's comments about having Mr. Patel on the meeting with us. He gave us a great overview of some very important factors that are affecting the stock market presently, and I think really added a lot to our insights and the meeting overall. But I think in looking, forward into 2023, I would have to say that if I had to pick a theme for the market, I would say preparing for more turbulence. I think for a variety of reasons, at least the early part of the year, first quarter or so, is going to continue to be turbulent the way we've seen, in the recent past. And there are a number of reasons for that. I think, the market is, I think, confused about a number of things, about the economy, about Fed policy, and that creates instability. I think the biggest focus for investors right now really is Fed policy and the economy. And the concern now is we will have a recession in 2023. We talked about this quite a bit at the meeting, and I would say that your committee as a group feels we will have a recession next year. It's difficult right now to really assess how deep that might be. I think in general, we feel it will be a mild recession. But then again, on the other side, coming out of that recession may not be a robust recovery either. So we may be looking for a longer period of what I'd call it's kind of an economic slog, if you will. So with the concern being that the Fed overshoots policy, we really have to think about positioning the portfolio for continued turbulence in the early part of the year. And I think we believe we want to continue to emphasize quality value stocks with high free cash flows. And we're still we get that exposure through the Pacer Cash Cows ETF, which we continue to hold. We also want to emphasize higher income through higher dividend paying stocks, because these types of higher dividend stocks do tend to be less volatile and hold up better in a higher interest rate environment. So I'd call the outlook for next year, I've heard it referred to as a tale of two halves. And I think that's a pretty appropriate description, in the sense that I think the first half is going to be turbulent and the second half is going to be better. Personally, I'm optimistic that 2023 will be an up year for the stock markets. But again, we still feel that the early part of the year will be turbulent, and we need to be mentally prepared for that, and also prepare portfolios for that. One thing that I'm encouraged about is several equity strategists who I have followed for years, who have a lot of experience, are bullish for 2023. Those are Jeremy Siegel at Wharton School, Ed Yardeni and also Jim Paulson at Leuthold. All three are bullish for a better 2023, and that gives me a fair amount of encouragement that our longer term positive outlook will come through ultimately. So with that, I want to turn it over to Len to talk about the international outlook.
Thank you, Bob. While the US waits for a possible recession, the economies in Europe are expected to experience a slightly deeper and potentially slightly longer duration downturn. As in the US, we feel that much of the downturn has already been priced into the markets, however, as international stocks have lagged the US even during this difficult year. And we've chosen to maintain our below normal allocation to international stocks. But we are augmenting our traditional holding of EFA, which stands for Europe, Australia, and the Far East. And these are the large developed economies there. And we're augmenting it with an ETF that's focused on high dividend paying international stocks. And this is going to help you in two ways. First, it will introduce additional yield into the portfolio, which helps to stabilize returns. And secondly, it's going to allow us to diversify a bit more away from Europe and a bit towards the areas of the other developed economies, which we frankly expect to outperform Europe during this period. With that, I'd like to turn it back over to Stan to talk about REITs.
Thank you, Len. In the REIT portfolio, it did not have a great quarter to last quarter, but we still feel that there's some excellent value. REITs, of course, represent all the major portions of real estate, and of course, they also must pay that out in the form of dividends. As we were talking about, dividends are something that we continue if this session to try to improve because there are some really good values out there now. We did add to the real estate portfolio, however, a REIT which specializes in medical buildings and medical properties. We felt that adding that also added a degree which would give us more value if we did get into a recession and a downturn. So with that, I'd like to turn it back over to Len to talk about fixed income.
Thank you, Stan. The Federal Reserve has dual goals of maintaining employment and keeping inflation low. And recently, they've opted to fight inflation at the expense of employment. Now, employment hasn't really suffered significantly, but in the past year, they've aggressively raised rates while trying to slow the economy. At some point, they'll stop raising and they will pivot to start to lower rates to try to help prevent a recession in hopes that they haven't slowed the economy so much they throw us into one. We're not going to try to time the exact moment of this pivot, but we have positioned ourselves with the idea that most of the increase in yields has already happened. And when the Fed then lowers rates, we'll take advantage of the fact that yields are higher and that most of the return on bonds comes from yield rather than price. To that end, we've actually increased our allocation to both the short and the long-term bond areas, but we haven't made any changes to the supplements that we use there, which have actually done quite well for us in the last quarter. Now I'd like to send it to Bob to talk about other changes in our model.
Thanks, Len. So as Len mentioned, interestingly, following the meeting, we actually, our net exposure to equities and fixed income actually went up a little bit. As Len indicated, that they went up a little bit in the bond area to, capture more yield, which we think is important at this time. It also increased in the equity area because of we increased our exposure to small cap stocks, which we think offer very good value right now. We wanted to take advantage of that in the portfolios. We also added, as Stan mentioned, income in the REIT area by adding a medical products, medical REIT in the REIT area. And we continue to maintain our position in the Pacer high free cash flow ETF, otherwise known as the Cash Cows ETF. I believe that's a great holding right now because companies that generate high free cash flows tend to outperform markets in which rates are rising and there's a fairly high degree of volatility. We also continue to maintain an emphasis in the metals area with our holding of XME, the Spider Metals and Mining ETF. And I think what's interesting there about that particular investment is the fact that right now we're currently seeing across all the base metals area virtually zero new capacity scheduled to come in for the foreseeable future. What that means is that as demand continues to grow for things like copper, aluminum, nickel, and other industrial base metals, that's going to continue to put pressure on the supply and will most likely implies higher prices for all of these base metals over the longer term, and higher base metal prices are the primary driver of those stock prices. So we think that that continues to be a very good opportunity. We also continue to hold the XLE, which is the Spider Energy ETF. We think that the same sort of supply-demand imbalances that are present with the base metals are also present in the energy area. And so we believe that that is another way to capture, as an inflation hedge, but also capture the returns that are going to be generated from higher prices across both the energy and the industrial metals complex. So with that, I'd like to turn it back to Stan for closing comments.
Thanks, Bob. And thank you all for tuning in. Before I get to the very end, I wanted to just cover the triggers that we set up for this quarter. As you know, the triggers represent things that we do not expect to happen, but would cause us to make changes in the portfolio if they did. We did continue to use the two triggers from last quarter. One of them was the University of Michigan Sentiment Index, which is currently in the 50s. We said if it went over 70, that would indicate more confidence from the consumer, and that would cause us to probably get a little more aggressive if that happened. The other one was one that, again, we certainly don't think will happen, and we certainly hope doesn't happen. But if the Russian Putin wound up exercising the nuclear option, then we would consider that a pretty big negative and reduce exposure. The one we added this time is one that relates to inflation. Inflation, of course, popped to a very big number, but the 12-month went down last period to 7.1%. And the work that we do internally shows that over the last few months, inflation has only been running at about 2%. So if inflation does start to come back up, then that again is a trigger. The number that we chose was if inflation, again, the 12-month average went over 8.5%, we would consider that a negative trigger as well. With that, I'd like to thank you all for tuning in, and I wish you all a very happy new year. Hope to see you next quarter.